Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin. Thank you.
Welcome and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. I'm Pam Amato Demagayas, moderator for today's webcast. And just a quick reminder that you can download a copy of today's presentation and supplemental materials in the webcast console. You can find it within the icon that looks like a file folder. Before we begin the presentation, I'd like to introduce today's presenter, Tracy Paglia. Tracy has 19 years of public accounting experience consulting with nonprofit organizations, their for-profit subsidiaries, and donors. She's the leader of the Moss Adams Tax Committee, serving the not-for-profit and government industry group, and a member of the firm's technical committee. Tracy serves clients all over the United States from her office in Stockton, California. Her clients include colleges and universities, associations, long-term care communities, hospitals, community organizations, and foundations. Tracy is a highly rated national speaker on tax-exempt issues. Her teaching and speaking experience includes sessions for the National Association of College and University Business Officers, the American Institute of CPAs, Council on Foundations, American Society of Association Executives, CalCPA, and Leading Age. She is a member of the AICPA Not-for-Profit Industry Conference Planning Committee. With that said, I'm going to turn the webcast over to Tracy to get things started.
Great. Thanks, Pam. I appreciate everyone joining us this morning. We have quite the audience today, so we're going to spend the next 55 minutes or so talking about fringe benefits, so hopefully you're in the right place for that topic. We're going to start off with a polling question, and remember you've got to answer the polling questions in order to qualify for CPE, so please, if you could take a look at the screen, we'd like to know how many employees does your organization have? Under 50 employees, 51 to 100 employees, 101 to 250 employees, or over 250 employees. After you've chosen your selection for your organization, if you could click Submit for us, kind of gives us an idea of how large of an employee base we're looking at here for the presentation. I'll give everyone just a second to do that. And we'll close out the poll. So it looks like we've got about 20% of our audience has under 50 employees. We have a large percentage at 56% over 250 employees. So a lot of large employers out there. I appreciate you guys giving us that feedback, and we will go on with the technical information. So there is a feature that you saw in the video clip to do a Q&A. So please feel free to answer or to enter your questions as we go. I'll try and keep my eye on that screen and answer them while we're in the pertinent section, but there is a ton of information here to cover. So if I don't get to your question because we run out of time or I just miss it on my screen, we will get back to you by email with your questions, with answers to your questions. So please go ahead and use that feature. Appreciate having questions for the audience. So we have to start the discussion about fringe benefits with the premise that every transfer to or benefit for an employee is taxable unless there is an exclusion or exception. When I'm having these discussions with clients, I always get the, well, that's not fair though, or we only do it once in a while, or it's such a small benefit, why are we worrying about this? Which are all reasonable questions to ask, but the IRS really doesn't care. They don't care that it's a small amount, or they don't care that it's infrequent, or that it's just not fair to tax someone on that benefit. The code says it's taxable unless we can find an exception. And fortunately, there's a lot of exceptions and exclusions, and that's really what we're going to be focusing on today is how can you provide these benefits to your employees tax-free? What does it take in order to do that? And if you have a lot of hurdles, you know, at what threshold are you going to decide it's just not worth the hassle, which is an internal decision to make? I'll just tell you what the IRS says, and I can, you know, commentate on what I've talked with other clients about, but you've got to figure out what's right for your organization. So the taxes that we're talking about are federal and state income tax, Social Security, and Medicare tax, so the payroll taxes as well as the income tax for the most part. That's not across the board always because, of course, anytime you have a rule, there's going to be an exception to the rule. But pretty much when we're talking about exceptions, we're talking about both income and payroll taxes. And we're going to be talking about a bunch of specific benefits, including the ones on the screen like gift cards, spousal travel, college tuition benefits, cars, and housing allowances, along with a bunch of others. So the way to start the discussion is first with what everyone is probably already familiar with, which is the cafeteria plan option. And that is a written plan, has to be written, and it allows a choice of only specific pre-tax benefits for the employee. And I've got them listed up here on the screen, the accident and health benefits, adoption assistance, dependent care, group term life, and health savings account. So these are going to be non-taxable for income tax only. This is one of those exceptions to the general rule where it is not going to get you out of the payroll tax, but it does get you out of the income tax. People are pretty familiar with this benefit, so I'm not going to spend a lot of time on these exceptions to the, you know, everything is taxable rule. We're going to focus mostly on the next slide, which is Section 132, which is kind of the big section that we use to exclude benefits for the most part, and I'm going to pull in some other code sections as we go. Rather than read through the screen that I have here, I want to refer you to the handout. If you have already downloaded or printed the supplemental materials, it's going to be much more helpful for you to look at that. It's going to be easier to read than what I put on the screen next, which is a screenshot of it. And I apologize in advance. It's going to have a lot of words on it. But walking through the handout for these 8 benefits I find is more helpful than just talking in generalities about them. So I am going to move to the next screen. But before I do that, I want to point out at the bottom of this screen, for any universities, colleges or universities who are on the call, Section 132 says that education or training can only be excluded under 127, which we're going to talk about college benefits here in a little bit, or as a working condition fringe. In all of my work and discussions and giving this presentation for higher ed audiences, I've run across a couple schools that want to use the no additional cost service exception for college benefit, and I just want to warn you, the code that I've cited down there specifically says you can't do that. So if you're using that no additional cost service as your exclusion, you've got to rethink your benefit there. So this screen that comes up, like I said, it's really hard to read on screen unless you have a big monitor that you're reading. So I refer you to the supplemental materials. Please, if you don't already have those, go ahead and download those and look at them. So this is a takeaway for you to keep at your desk. So in the future, when you have questions on fringe benefits and how we can possibly exclude a benefit from being taxable for an employee, this would be a good place to go to. So the no additional cost service is is one that we use quite frequently, and it has 5 pieces to it with the bullet points we have there. It's a service that's offered for sale to customers other than employees in the ordinary course of the line of business of the employer in which the employee is performing services. So one thing that we think about here, it's been around for a long time, is airlines. Airlines, planes take off, and they have a bunch of seats, and people pay for those seats. And sometimes, not usually this time of year, but sometimes there are empty seats on that plane. And so for a long time, the airlines have had the policy that airline employees can sit in those seats and not have to pay for them. So that is a no additional cost service as long as the employee is in that line of business. So if you have an airline stewardess or you have a pilot, very clear that they're in that line of business. But if that airline also owns a bus transportation company, they can't provide that benefit to someone who's in the bus division because they aren't in the same line of business. In the college and university area, we have athletic tickets. So a sporting event happens, and at the start of the sporting event, there are empty seats. It's very common for colleges and universities or for organizations like concert halls or opera companies, they have extra seats. And they can provide those seats to employees at the last minute. But it has to be someone who's in that line of business for the organization. The second bullet point is the employer incurs no substantial additional cost, including foregone revenue, in providing the service to the employee. So if that concert seat is available at the time the concert starts, that's really excess capacity, and the IRS says it's fine if you want the employee to sit there. But you can't give them that seat a week ahead of time because then you could be foregoing revenue. Someone may buy that seat right up to the last minute, and you have foregone revenue because you've given the employee the seat. So for a college and university situation with the athletic tickets, you've got to weigh how soon before the event happens are you going to give those tickets to the employee and say that there's no foregone revenue. So that's an important decision point. The third one is the benefit is available for retired disabled employees, surviving spouse, current spouses, and dependents. So we're going to find with these exceptions and exclusions that sometimes you can provide the benefit to more than just the current employee. Not only can you provide them a concert ticket for the employee who works in that line of business at the last minute, but they could invite their spouse or their dependent and bring them as well. Fourth bullet point is there is a reciprocity agreement option here. So if you have 2 theater companies, who are totally unrelated, they could have reciprocity agreements that say, we'll give your employees excess seats if you'll give our employees excess seats on the same basis. And then finally, it's only available to highly compensated employees if there's no discrimination. You cannot have the policy where only your C-suite people are eligible for this ticket benefit, for example, because then you'd only have the highly compensated employee who is eligible for that benefit. Okay? So the second bullet point, or the second fringe benefit option, exclusion, that we have here is for our qualified employee discount. The definition is important. It's what anyone would expect a discount to be, which is the price at which the property or service are provided by the employer to an employee for the use by the employee is less than the price that you're charging the employer. Sorry, I've got a little bit of background noise. If there is a problem, if you can hear it, please let me know and I can tell the construction upstairs to stop. So it is the price provided to the employee for use less what what you're offering it for sale, so discount there. The exclusion amount can't exceed the gross profit if it's the price the property is being offered in the normal course for sale to customers. If it's a service, it's a 20% reduction. So let's use a bookstore example or a gift shop example. If you have a property, you're selling in the gift shop or in the bookstore, and you sell it to the employee at cost, that's okay. That's fine. But if you sell it at below cost, the additional discount is not a non-taxable benefit. That additional discount is going to be taxable to the employee. Qualified property or service, it's going to exclude real property and personal property held for investment, and it includes only property or services offered for sale to customers in the ordinary course of the line of business that the employee is in. So same situation we talked about before with the airline and the bus situation. You cannot offer a discount at a bookstore to an employee who works in a different line of business. That's not going to work for this particular exclusion. That benefit is available for more than just the current employees. So you've got retired and disabled employees, surviving spouses, current spouses, and dependents, and you have that same highly compensated, no discrimination requirement for this one. Those don't apply to all the fringe benefit exclusions we're talking about, but I wanted to highlight that it does apply for these first two. All right. Working condition fringe, we see this one all the time. This is a really helpful one. What you have on screen is very brief. It's any property or service provided to an employee of the employer to the extent that if the employee paid for that property or service, the payment would be allowed as a deduction as an ordinary or necessary business expense or as depreciation. So I'm a CPA, right? I'm a partner in the firm, used to be an employee. If I drive up to the Sacramento airport to fly to go to a client meeting, I would be able to deduct that mileage if I was in my own business. So say I'm an employee here, if I'm reimbursed for that mileage, it's not going to be taxable to me because that would be an ordinary or necessary business expense. So this, you can see, can have very wide-reaching applicability for every type of organization. If you can make a business case for reimbursing the employee for that expense or paying a third party for that expense for the benefit of the employee, say you have someone who needs some personal coaching on leadership skills or presenting skills, if you pay a third party for those services, it's not going to be taxable to the employee as long as it helps them do their job better. So this is a very widely used exception that really makes a lot of sense, but you've got to look at your specific facts and circumstances. All right, de minimis fringe, number 4. This one is also used a lot, but unfortunately I see this one used a lot incorrectly. So the bullet points here are really important. The first one is any property or service, the value of which, after taking into account the frequency with which similar fringes are provided, is so small as to make accounting for it unreasonable or administratively impractical. So this is often what we'd use like for a coffee and donuts example. You come in on Friday morning. I know here we have coffee all the time. We have donuts on Fridays, and we'll have birthday celebrations once a month and bring in food. Well, it's administratively impractical to try and track who availed themselves of that benefit and how much that benefit is. Now remember, you provide anything to employees, it's going to be taxable unless you have an exception. So with this one, if you're only providing it infrequently and it's not reasonable to track it on a per-person basis, then we can use this exception potentially. Now, this never applies for gift cards. I have people all the time tell me we went out and bought 500 $5 Starbucks cards and we give them out randomly to employees. We don't track it. We cannot use the de minimis fringe for that purpose because that's just like handing them a $5 bill. And the IRS has said this de minimis fringe exception doesn't apply to cash, doesn't apply to gift cards. The other piece I want to point out on this first bullet point is the frequency. So I talked about coffee and donuts in the break room. If we do, let's say, cocktail hour every week, and I take my staff out and we buy cocktails and we buy appetizers, and we do this every week, that frequency starts to look a little too frequent, maybe, to the IRS. There aren't any bright line rules, but when you're looking at that benefit that we're providing, the cocktail hour, cocktails and appetizers, if it's happening weekly, the IRS could make the argument that it's too frequent. This is one of the problems that Silicon Valley is running into now with providing a meal benefit to their employees. You may have seen some of the articles about how they have these extravagant meals that they're being provided. This is one of the ways that those for-profit companies have been providing the benefit, not taxing their employees. But the IRS is starting to question, boy, if you have these lavish meals available every day, is that a little too frequent? Does this really still apply? The second bullet point is there are certain eating facilities that you can provide meals to employees. It has to be located on or near the business premises of the employer, and the revenue derived from the facility has to cover the direct operating costs of the facility. So if you're providing free meals to employees, you can't use this exception if you aren't charging, because you aren't charging enough to cover the direct costs. I've seen this one used for benefits on college campuses where you have a cafeteria. It's located on the business premises. It's okay that it's run by a third-party vendor. That's fine. But you've got to test that the revenue derived from the facility at least covers the direct operating costs in order to use that exception. There is no line of business rule here. So this use of the eating facility potentially has more use or coverage compared to the no additional cost service and the qualified employee discount we talked about before that does have the line of business requirement. Finally, you can cover on-premises gyms or other athletic facilities under this de minimis fringe. The key here is it has to be substantially used by employees, spouses, or dependents. So a lot of the athletic facilities that I see, the YMCAs or the colleges that have athletic facilities that they make available to employees, this exception generally won't apply for them because you don't have that substantially all of the use requirement met. But if your office building has a nice little gym, I know our Sacramento office, the office building itself has a little gym with a couple treadmills, a couple ellipse machines, that is going to be fine because substantially all of that is going to be used by your employees, spouses, and their dependents. So that's a potential other option for you. Qualified transportation fringes. This is going to cover your commuter highway vehicle benefits, your transit passes, your qualified parking. And on this sheet, I do have the 2015 amounts. I didn't put the 2016 amounts in here. I don't know that I've heard of those being released. And then if you have a bicycle commuter, the fourth bullet point there is a $20 monthly reimbursement for anyone who commutes by bicycle, which is a nice option if you have that choice. The qualified moving expense reimbursement, number 6, we're going to talk about in more detail a little later, so I'm going to skip that one. The qualified retirement planning services, that one is a very narrow fringe benefit that you can provide. It cannot be made only available to highly compensated employees, so you've got to make these retirement planning services available on a more wide basis. And I'm not going to also cover number 8 because I just don't see the base realignment and closure fringes. But in your supplemental materials, one of the last things I have in there is an IRS publication that talks about these fringes in more detail. It is Employer's Tax Guide to Fringe Benefits 15B. So all of these are covered in more detail in that handout as well, which we won't go into at this time. So I'm going to start applying some of this information, right? We have the major exceptions and exclusions under 132 kind of under our belts. You've heard a little bit about the restrictions and the requirements. So let's start, applying this information to benefits you actually see in your organization. So the first one is meals and housing. And we like to use, if possible, the convenience of the employer exception rather than the 132s that we were talking about a moment ago. There are some requirements here, though. In order for the meals to be for the convenience of the employer, there has to be a non-compensatory reason for providing the meal. The employee needs to be present on the premises in order to perform their duties. So you're giving them a meal so they don't go somewhere. So think of someone who works in an emergency room. It makes sense to provide them a meal during their shift in the cafeteria in the hospital. That way they don't have to leave the hospital in case there's an emergency that calls them back. They also have to be, I already covered those couple of bullet points. So that's the big thing, is you've got to be able to document the business reason for giving them that food. We're going to talk about housing in a little bit after we cover meals. So we'll talk about the next exception for meals, which is the working condition fringe. We covered that one a moment ago under 132. This is the one where if I have a business meeting, I'm taking someone to lunch, say I'm taking another employee to lunch because we're doing a coaching session. I can give that employee that meal for free because we're talking about business, and I don't have to charge them because it's a reasonable business expense. So under 132, I don't have to add that either to my W-2 or to theirs. The final one is the de minimis fringe. It's the one I referenced a little bit earlier where you have the occasional company picnic. This is going to be your Christmas party as well, cocktail parties, coffee and donuts. So it is a fringe benefit that is not provided frequently, and it's administratively impractical to track. Those are the keys. But you've got to look at that frequency. That's where some people get caught up. Housing is really a benefit that the IRS is looking at very closely in higher ed for sure. I've not heard about much traction outside of higher ed, but they are definitely focusing on it in the college and university context. So in your supplemental materials on page 3, I included an article that I wrote last year having to do with the convenience of the employer exception for housing, as well as temporary work locations and then a special valuing option for educational institutions. So I really encourage you to take a look at that article if you haven't seen it already. People often misunderstand the convenience of the employer for housing. What the fact pattern I usually see is you have someone's employment contract that says you're required to live in this house, and you can't live anywhere else. We're not going to give you a stipend. And that's it. That's all it's done. Then they say, oh, convenience of the employer exception is met. We don't have to tax it. That's not the case. You've got to go a little farther than that. The first thing is it has to be furnished for the employer's convenience. You've got to be able to show the IRS that there's something that this person does in their position that requires them either to live in that particular house or to live very close to campus. Think of a resident advisor on a residential campus. You have either a student or an adult who lives in a unit, generally in the dorms or very near the dorms, so they're available 24/7 to the students. They may have office hours, but pretty much they're going to be the first line for emergency response if a student needs something. That's pretty clear that in order to do their job, they have to be there. Let's contrast that with an administrator at a hospital, right? The top person at the hospital. How important really is it that they live close to the hospital? They're not a physician who's going to be responding to emergencies. Generally, if something goes wrong with the facilities, you have a facilities person who's going to respond. Yeah, it's important that they're notified in the case of an emergency, but is the hospital administrator really the one who's going to be responding to that emergency? Does their job really require them to live next to the hospital or within 2 miles so they live in a hospital-owned facility or a hospital-owned house? We have this problem all the time with the presidents of universities. You have a president's house, which tradition says the president has always lived in that house. But is there something in their job description that says they have to live in that house? Is their house used enough for business purposes like after-hours meeting or housing people who are coming in to visit or meeting with donors or having meetings that don't make sense to have in an administrative office like confidential meetings? Is the home used enough that you have to argue that person needs to live there, that president needs to live in the house? If you can't meet that test, you can't use the 119 exclusion, and that housing is going to then be taxable for the employee. So required as a condition of employment. Often the employment contract will say you have to live here. We're not going to give you cash in lieu, and you can't have the job if you don't live here. The IRS has said that's not good enough, but the employment contract will cover that second bullet point. The third one, on business premises, it has to either be near where your business is happening or actually on the same block or in the same buildings as your business is happening. So say you have a museum and you have an apartment upstairs. That's clearly going to be on the business premises from a proximity standpoint. And if you have someone who needs to be available in the case of an emergency for the museum, like there's a fire or respond to a break-in, that would make sense that the person would need to live in the apartment above the museum. Now, if you get a couple blocks off, say a college campus where the president's home is 3 blocks, 4 blocks, 4 miles away, we start having more of a problem with the on-business premises unless you can show a significant amount of use of the home. I do have a couple questions here, but I think for time purposes, I'm going to keep moving and see if we have time for questions at the end. So we've got our second poll here halfway through. Does your organization provide a housing benefit? We have the answers of no housing benefit. Yes, we have a taxable benefit. Yes, we have a non-taxable benefit, so we're saying that we meet that convenience of the employer exception and have that non-taxable benefit. Or number 4 is not applicable. If you could please take a moment, answer the question, and click submit. We will take a look at those in just a moment. All righty, let's see what we've got. All right, so 60% of the people on the call say that you do not have any sort of housing benefit. We have about 10% that have a taxable benefit, about 20% with a non-taxable benefit, and about 11% that are not applicable. So for those of you who have the non-taxable benefit, just take a look, make sure that your files fully support that non-taxable benefit. The IRS is definitely interested in that. All right, next benefit, cars, right? Cars I see all the time on university campuses. I don't often see them outside of that. I don't have a lot of exempt organizations that provide cars other than like the athletics department of a college or university. But it's a good refresher. These rules have been in place for a really long time. No change in this area. But if you're providing a car or a car allowance to any of your employees, by default it's taxable, right? By default, everything is taxable. But if they can document the business use of that car by documenting the beginning mileage, the ending mileage, the business purpose of the trip and the date, then you can use the working condition fringe benefit exception to exclude the value of the business use of the car, or the business portion of the car allowance that you're giving them. Failure to provide that adequate accounting is going to result in the whole value being taxable, and the IRS is a big stickler about this. And I often find the people who have the cars are the worst record keepers. They're usually, the heads of departments or the heads of the organization. They're very busy people, and they don't want to keep car logs. So I've had some organizations that have said, it's not worth the hassle. We chase these logs all year long. We just can't get them in sufficient detail, so we're just going to tax the whole thing and call it good. That's certainly a way to go. If you don't do that, if you want to treat some of this as a non-taxable benefit, you've got to have those records, and they're supposed to be contemporaneous, so taken at the time of the use of the car. I will tell you often we have to rely on administrative assistants to kind of marry calendars with mileage logs maybe each month and then submit that to the payroll department to show the portion that should be non-taxable and taxable. Very important that you have those logs. I recently had an IRS audit with this issue, and the agent was actually a little on the nice side and let us provide after-the-fact documentation that wasn't in place at the time, which they don't have to do that, but this agent did, and so we were able to decrease that taxable portion. But pretty much any time you have a car, you're going to have a taxable portion and a non-taxable portion. It's important to document that business use. You can see IRS Pub 463 for more information on that. Next is cell phones. Fortunately, in 2011, we got some good guidance from the IRS, finally. For the longest time, the cell phones had to have the same record-keeping requirement as the cars, which was ridiculous. So they came out in 2011. I've got the notice number at the bottom there, that the business use of cell phones are going to be excluded as a working condition fringe if there's a non-compensatory reason for providing the phone. So if you give a phone to a person who's at a desk 8 to 5, Monday through Friday, they have a desk phone, they aren't available or they aren't required to be on call weekends, evenings, they don't really need access other than the 8 to 5, Monday through Friday, it's going to be really hard to document a non-taxable fringe benefit for that person for the cell phone. That's going to be a taxable benefit that you got to add to their W-2. But if the file, when you give that person the phone, you document, hey, this person needs to check their email, they need to be available by phone, evenings, weekends, this is, a very common thing, but this position requires it, then you can provide that non-taxable, and the personal use is going to be excluded as a de minimis fringe benefit. The only exception there is if you have someone, say, who runs up a huge bill because you don't have international calling on their phone that you provided. They don't need to have international calling for a business purpose. They just have a boyfriend in Argentina and run up a bill. That extra amount is going to be taxable. You're not going to be able to exclude that as a de minimis fringe because it can be accounted for, right? The de minimis requirements are it has to be infrequent and not reasonable to track. In that case, you can pretty clearly see the excess charges. So that's going to be a taxable benefit unless they reimburse for that. So if you want more information on cell phones, see that notice that I've cited there at the bottom. The key thing to take away here is make sure your files have documentation of the non-compensatory reason that that person needs the phone and needs the data plan and the minutes plan. And have a policy on how often you're going to revisit that. I often see people move within the organization into different positions, where in one position they may have needed that phone and that plan, and in another position they may not need it. Or someone leaves the organization. What are you going to do about that phone? Is it the policy that you're going to get it back and then have to deal with the disposal? Or does it become their phone as soon as they get it? What happens if you give someone a cell phone and they leave a month later? Do they get to keep that $700 phone that you just bought for them? And are you going to treat it as additional compensation to them if they leave within a certain period of time or have them return the phone? Gift cards. Oh boy, gift cards. I didn't ask a polling question on this one, but often when I start the topic on gift cards, some organizations have the policy that we're just not going to have gift cards at all. We're not going to reimburse for gift cards. We're not going to condone gift cards. We just don't want to deal with them because gift cards are a hassle. They are treated as cash. They are always cash from an IRS standpoint, and they are always taxable when you give them to an employee. It's even a $5 Starbucks card they want you adding to the W-2 and taxing, which is very onerous, but the de minimis rule we talked about earlier doesn't apply here. So you've got to figure out for your organization what makes sense. Are we going to institute a threshold that says a $50 gift card, if it's below that, we're not going to worry about adding it to the W-2, but anything above that we want to add to the W-2 and make sure that it's being taxed. Maybe your threshold of pain is $25 gift card. You've got to decide internally what that is. The IRS says it's all the way down to zero, so there is no guidance out there that will tell you what a threshold is for gift cards. I think there's an exception for very restricted certificates. This gets back to kind of the whole Thanksgiving idea where employers used to give a turkey or a ham. And people start complaining, well, I don't like turkey, or I don't like that kind of ham, or I'm a vegetarian. So employers started giving Safeway gift cards instead. Safeway gift cards are too broad. It's just like giving them cash in an envelope. So if you have something in between, which is a very restricted certificate, that might not be treated as cash. An example you can think of is a T-shirt from the gift shop. So they have a certificate that's good for one T-shirt. It's just like giving them a T-shirt and then they can go and exchange it. But you're just removing that extra exchanging step because you don't know what size or color they might want. So you might be able to get away with a very restrictive certificate like that, but it's got to be for a single tangible item, something like that. Awards. Awards are very specific and very narrow. So the first one we have are qualified scholarships. That's under 117. You can provide a scholarship to an employee or their dependent if you have a broad base of criteria, or if you have criteria that will result in a broad base of potential recipients. So let's say your organization has over 250 employees. Let's say you have 1,000 employees, and you start a scholarship program that would be for an undergrad degree for someone either who's an employee or a spouse or a dependent of an employee, and they have to have a GPA of 3.0 and be going to a 4-year school. Let's say those are your criteria. If you have 1,000 employees and you look at their spouses and their dependents, you might have an eligible pool of 5,000 people. That's a pretty good-sized pool. So if you give a few scholarships to people in that pool, the argument can be made that it's not in relation to the employment, it's not a benefit to the employee because under 117 it's a qualified scholarship that's going to be used for qualified expenses. However, if your organization only has 10 employees and you have those same criteria, your pool of potential recipients is going to be way too narrow, and the IRS is going to say that's a taxable fringe benefit unless we can meet one of the college exceptions. Meritorious achievement, this is usually the Nobel Prize example, and the key here, it has to be given to a government unit or a charity designated by the recipient. So the person is an award recipient, but they don't actually get it. They say, I don't want it, give it to this university, or give it to this hospital, or give it to this nonprofit. So they aren't actually receiving it. The third one is Employee Achievement Awards, but those have to be tangible personal property, and it has to be for safety or length of service. You can't give them a gift card. It's got to be tangible personal property. So this is the gold watch example. And you've got to look at the frequency. If you're doing this every year for people, it might be a little too frequent for this particular exception. So that is a pretty narrow awards exception. The final one is a de minimis fringe. If you are giving people a gift on their anniversary, like a T-shirt or a pen, something that is nominal in value, and the frequency is once a year, one time for each employee per year, you could probably use the de minimis exception rather than that Employee Achievement Award that I talked about, which has much higher thresholds. College tuition. Okay, what you've got on screen is a little fuzzy. I apologize for that. My screenshot wasn't as clear as I'd like. There is a handout. So page 6 of the supplemental material has the more detailed table, and I tell you, I refer to this all the time. So if you're ever trying to figure out college benefits that you can provide to your employees tax-free, this is where I'd go. I've got a little snippet at the top of it on your screen. It talks about the qualified education assistance, the 132 Fringe, working condition Fringe that we talked about before, and the 117D qualified tuition reduction. You also have the regular 117 scholarship, which isn't on this table, but I tell you, this is where I go all the time. So to help apply this information, and we'll do this kind of quickly because I talked a little too long on the 132 slides, we're going to apply a couple examples. And I'll show you how I walk through this every time. So on the next slide, I've got 4 scenarios here. So if you have the supplemental materials handy, you'll want to go to page 6 to look at the table so you can walk through this thought process with me. If you don't have the supplemental materials available, you can take notes and you can go look at it later. The first one is a public speaking course for current employee. Someone comes into your office, you are the HR payroll person, you are the accounting department. Someone comes into your office and says, I have this employee who needs to be doing more public appearances, more teaching. I want to get them into a public speaking course, and they're a current employee. Right? This is going to help them do their job better. When we look at the table and we take a look at the working condition Fringe, it covers undergraduate courses, graduate courses, no written plan is required, and it is job related. So that's going to be the direction that I go. It's something that's going to help them do their job better, so it's going to be a 132 Fringe. That's not going to be taxable to them. All right, next day, you have someone else inventive coming into your office saying, I got this employee, they really need to go to graduate school. They're a current employee. We really like them. We want to keep them. We don't want them to leave. But they have this love of the theater, and the way to make this person happy is to help pay for their graduate tuition for a theater degree that has nothing to do with the job they're doing here. We just want to keep the employee happy. Right? We can't really use the working condition Fringe because there's not really a business purpose for me as the employer to pay for that person to go get their graduate degree in theater. So we're going to look at the other options. And when we look at the table in your materials, we see that the graduate, which is the third line down, the only option we have is under 117D for the qualified tuition reduction. Covered for current employee, not job related. Yep, so we've got, I've got an error on my slide. We are going to say undergraduate tuition, right? Oh no, I said it, sorry, I did it right. See, I did it right when I set this up yesterday. 127 does cover graduate school courses. I see I run into this all the time. So graduate school is covered under 127, but you have a 5250 limit per year. The IRS keeps juggling with this. They haven't decided yet if they're going to keep extending that 5250. So the plan must be written. You can't discriminate in favor of highly compensated employees. So if this one employee you want to keep happy is the only employee in the plan, which under 127 it has to be a written plan, so you're probably going to already have a plan in place. But if they're a highly compensated employee and you write a plan specifically for this one person, you're sunk because they're highly compensated. But if they're a lower level person, you'd be okay. You've got to look at those restrictions. The next example I have is graduate tuition. Again, graduate tuition. So when we look at graduate, we have the option of 127, 132. We do not have the option of the qualified tuition reduction, but this is for a current employee spouse. When we look down under the definition of employees, we can include family members only for 117, but that doesn't cover graduate tuition unless if they are doing research or teaching activities. So our answer on this one is it's taxable. You can offer that graduate tuition benefit for an MBA for a current employee spouse, but it's going to be taxable unless they're also doing teaching or research for the organization. Finally, the scholarship we talked about a moment ago, we can use the 117 exception if the pool of candidates is sufficiently large. These are probably the most common situations I run into, in addition to an undergraduate benefit, which I run into very frequently. All right. Next polling question, we've got about 17 minutes left to go. So does your organization have a college tuition benefit? I'm guessing given the demographics of the people who are on the call, we might not have many people with a tuition benefit. But I wanted to ask the question just in case because I'm always interested to see who's got them. The potential answers are none, no college tuition benefit for our employees, no undergraduate, no graduate, nothing. Yes, but it's only a scholarship plan. It's a 117. Our employees and spouses and dependents can get these qualified scholarships. We have a tuition discount. That's a third option, yes. The fourth one is yes, but it's some other kind of plan, one that I didn't include in the prior bullet points there, or not applicable. I don't know that not applicable is going to be applicable for anyone this time, but wanted to provide it as an option. So please choose your selection so you can get your CPE. And we will close the poll here. All right, so about a third don't have any tuition benefit. I'm actually kind of surprised that it's as high as it is. We've got tuition discount at 29%, and we've got other types of benefits for 26%, so that's pretty good. Definitely take a look in the supplemental materials at that table. Every time I have a question on college benefits and can we provide it and how can we do it tax-free or how can we structure it, that's always where I go. That's the best resource that I found. And now you have it. So very helpful for you. Moving expenses. So I have a couple slides here on moving expenses because this is one of those benefits that I find all the time. You have a department who finds a candidate. They've interviewed for the position. They found the person that they want, and they promise them the sky without talking to payroll or accounting departments. They promise they're going to cover all sorts of costs relating to the move, and they don't ever talk about whether it's going to be taxable or not. The employee has all these expenses covered as agreed in the contract, and to get them to come, and then they get this big tax bill, or their pay is significantly cut, their take-home amount, because they have to pay for the taxes. So it's important that we know what's covered and that you teach your people who are making these promises that you guys really need to tell this new employee that not all this stuff is going to be tax-free. And are we, the employing organization, going to cover the tax or not? Most often not. Most organizations I talk to don't want to cover the payroll tax and the income tax consequences of these, unless if it is like the top seed. So it only covers reasonable expenses for moving of goods and travel one time. If you do any more than that, it's going to be taxable. So you got to watch for delayed reimbursements. I find this very often where you have people who come into your employment, but they leave their family back home, where it was before, so the kids can finish school. Or they incur all these expenses but don't give you the receipts in time to request reimbursement. They are falling outside of the accountable plan. Find that problem all the time. Unaccounted for advances, just like any other accountable plan situation, they've got to give you receipts or refund the advance within a certain period of time, or it's going to be taxable. And non-qualifying expenses reimbursed to or paid to a third party. This one is really important because often when you're reimbursing moving expenses to an employee, you're writing the check to the employee. So in your mind, we need to code this taxable or non-taxable. But if you're paying the moving company, or you're paying the storage company, or you're paying the lease on an apartment, or you're paying the utilities on an apartment as part of a move, those might not always be tagged as taxable to the employee. So you've got to make sure you've set up your system for those third-party payments. Time test, we've got to make sure that that person works 39 weeks in the first 12 months of their relocation, or none of the benefit can be provided tax-free. So we have had situations where people have moved first and then gotten a job. So you've got to look at this time test to make sure that they're going to meet those requirements. Often if they move first and then they get the job, you can't reimburse the moving expenses. It's much harder to do. The last piece is the distance test, and I thought a visual might be more helpful than me just talking about it. I find this is much more impactful. So former residents on the left, they used to have a 3-mile commute to the old job at the top. The new main job location is 58 miles away in the middle of the screen. They have increased their commute from their former residence to their new employment by 53 miles, which is over the 50-mile distance test. But at the bottom, if their new main job location from their former residence is only 38 miles, there's not enough of a distance there. They don't meet the 50-mile distance test. So anything you reimburse to them under the moving exception is not going to be tax-free. You're going to have to tax them on everything you reimburse if that distance test is not met. And you have to meet both the distance and the time test. So very important that you are paying attention to these details, and it's all in relation to the former residents. You don't care about the new residents in any of these tests. All right, so test for you. You can test your knowledge here. We've got taxable or non-taxable. That's what we're trying to figure out here. So you have a new employee who is about to be signed for our first example. So you have a prospective employee and their spouse that you fly out to California from New York. So you've got their airfare and their lodging to interview, because of course the spouse is a very important part of a recruiting effort, especially if you have a highly compensated person. So you're flying both the spouse and the employee out for the interview. Second scenario is that prospective employee has now signed an employment agreement, but they haven't moved yet. They're still in New York. They haven't actually started working for you yet, but they've signed an employment agreement. They have post-acceptance house hunting trip that they fly out to take a look at homes in California from New York. What do you think? Quick answer to yourself. Taxable, non-taxable on the first two. First one's going to be non-taxable. That person isn't your employee yet. That's a normal, reasonable business expense to pay for travel for a prospective employee that you're trying to recruit and their spouse. No problem there. But once they've accepted the employment, once they've signed the contract, they're going to come work for you. They haven't even started yet, but once they've signed that contract, that house hunting trip is not moving the household or the goods or the people one way. So that's going to be taxable to them. Unfortunately, you've got to think about that. You can pay for it, but it's going to be taxable. Lodging in the former location after the furnishings are transported to the new location. So they're in New York. They have to box up everything in their home, put it on the moving truck, send it out to California. They can't live in the house anymore after the furnishings and everything are gone, so they stay in a hotel for a night or two before they hit the road to drive out to California. The second one is they had to take a loss on that sale of the house in New York to relocate out to California. You wanting to recruit them as part of the package, say, we'll cover any loss on the sale of your house up to a certain amount or within a certain period of time. First one is going to be non-taxable. The code says, the rules say that if the former house is not habitable because all the furnishings have been moved out, there is a little bit of leeway there to pay for housing at the former location as they are moving out. But any loss on sale of the former residence that you pay for, that's going to be taxable. There's nothing in the code that allows that to be a tax-free benefit. And everything is taxable unless there's an exception. Oh, I clicked too soon. Temporary lodging for the employee in the new location prior to family relocating is going to be taxable. Their tax home has moved. Whether they've sold their house in New York or not, their main business location is now in California. There is no business reason for them to be in New York. So any temporary housing you provide or pay for before their family moves out is going to be taxable to them. And you can pay for storage costs up to 30 consecutive days for the moving of goods, as long as it is just 30 days. So if you're paying that third-party storage company, you've got to keep track of that time to make sure after 30 days you're cutting it off. Spouse travel, that's a big one. There's a huge disconnect, I find, between what an organization thinks is a reasonable business purpose for a spouse to travel versus what the IRS thinks it is. There's actually a specific section in the code under 274 that says spouse travel is taxable, period. Spouse travel is taxable unless they're an employee. So that spouse travel has to have a bona fide business purpose to be non-taxable, and one that either the organization is willing to fight tooth and nail on, saying it's a business purpose to us, and knowing the IRS is probably going to disagree. So an example I run into all the time is you have the president of the organization and their spouse who go and meet with a prospective donor and their spouse. So a couple who's a prospective donor to the organization. Every organization I talk to says it's imperative that the spouse be there. If the donor is a couple, the president or the VP of development and their spouse need to be there. They need to connect on a couple's level. The IRS disagrees, generally speaking, because if the president was single, they could do that meeting on their own. They wouldn't bring someone else just to have two people there to meet with the couple. Now, if the spouse, the president's spouse, is the one with the relationship to the donor, that clearly has a business purpose, and there you could cover the travel and the meals and everything for the spouse. Children are hardly ever covered. So if you're traveling and you're making the argument that the employee and the employee spouse have business purposes to be there, but you're also paying for the children's meals, say you're having a group dinner, that is going to be taxable. Documentation's key. I've had some organizations consider employment or volunteer agreements for the spouse if they believe there's a business purpose for them to be traveling and want to pay for that and not have it be a taxable benefit. I have other organizations that understand this is an uphill battle, and this is one the IRS will fight with you on. So they have said, we're just going to treat all spouse travel as taxable and just gross it up, pay for the tax because it's not worth the fight. Club memberships continue to be taxable. If it's a business, pleasure, recreation, or other social type club, the IRS continues to fight that those are taxable. One of the problems is often these country clubs won't allow a business to be the holder of the membership. They require an individual to be the holder. Now, I did have an exception. I had a client who was in kind of a rural area, and when they'd go to visit with donors, they had a country club memberships in a couple larger metropolitan areas where they had large amounts of donors. And so the only time that country club membership was used was when that executive was in that metropolitan area meeting with donors because they needed a base to meet from. That was a pretty easy argument that there's absolutely no personal use there. But contrasting, if you have a person who has a membership at a racket club and they have to have it personally because the organization can't have a membership, and their spouse has a membership and their kids have a membership, it's much, much harder to make an argument that anything other than the business-specific meals is non-taxable. So documentation is key, very necessary to treat it as a non-taxable benefit. These rules haven't changed in a long time, so this is the rule that has always applied. I have a couple slides for you on retirement and health care, but I'm going to skip over those because of time, and also because these are usually under cafeteria type plans or they're pretty normal benefits other than the 457F plan. I do have a couple watch for bullet points on each of these slides, so I encourage you to take a look at the slides afterwards. It is in the supplemental materials, so just things to watch for with your health care coverage and your retirement coverage. The last benefit I wanted to talk about, just be really careful if you have any sort of comp time or vacation policy that you allow cash out of. Had a situation recently where the policy was that you couldn't cash it out, but the practice was you could go to your supervisor at any time and request a check, which makes the benefit taxable when earned rather than when paid. So because their practice allowed cash out, the IRS said it was clearly taxable when earned, not when paid. So we've got just a couple more minutes here, so I wanted to bring up this slide. When is an employee also an independent contractor? The IRS has taken the 20-factor test that has always been in play, and they've categorized it into three buckets: the behavior test, the financial test, and the relationship test. If your organization doesn't have some sort of checklist on figuring out when someone is an employee versus a contractor, I highly encourage you to get one in place, or have people in your organization who are comfortable and qualified making those decisions. You'll want to send them to this URL that I have up here on the screen. It talks about each of the behavior, financial, and relationship tests, what factors to consider in each of them. There isn't one factor that trumps all, but generally when I do these tests, there's usually, in the facts and circumstances, there's one or two that really make the decision on if it's an employee or a contractor. If you have someone who you think is both an employee and a contractor, you want to look at the Ramirez versus Commissioner ruling that came out not too long ago, which agreed that someone could be both an employee and an independent contractor in that case. It was very helpful. So final poll, we're down to our last couple minutes. Do you review your W-2s and 1099s before you file them for any crossover recipients? What I mean by that is, do you look at your 1099 file and your W-2 file, sort them by Social Security numbers, and see if you have anyone who's receiving both? This is something the IRS does on audit. So I'd just like to know, audience, since we have a very large audience today, yes, you look at those two lists and see if we have any crossover. No, we don't currently do that, which if you're a large organization, I highly encourage you to do that because the IRS will, or not applicable. If there's anyone on our call that it would be not applicable for. Since we're coming up on the end of the year, if you don't already do this, it's definitely something to consider. So we'll go ahead and close the poll. Good. I'm glad to see about half of the people who responded do go through a process of comparing their W-2s and their 1099s. And it is possible to have both of those. You've just got to be able to explain it if the IRS comes in and asks. So I do have a resources slide for you here, a couple URLs, and there's several others that I had throughout the presentation for topic specific. But if you want more information, here's a couple IRS guides. I have a link to a free site that you could see the 132 code if you're a code person and like to read more, tax benefits for education under Pub 970, and Affordable Care Act, which is huge, which I totally skipped over because we didn't have time for that. But that's very important. So Pam, I think with that I'll turn it over to you for closing.
Yes, thanks, Tracy. And also, we received, several questions, were submitted during the presentation. So just want to let the participants know that we will be following up, after this webcast to get their questions answered. So thank you again to Tracy and to all of our attendees for participating in today's webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive credit. You can find that sheet in the file folder icon of the webcast console. If you participated as an individual, you should be able to view your CPE progress in the certification widget of the webcast console. If you met all certification requirements, you should see a download icon in the bottom right-hand corner of the widget window and be able to download a PDF copy of your CPE certificate. I'll keep the webcast console open for a few minutes to give you time to download your certificate. Also, please visit our website, mossadams.com, to learn more about future webcasts, subscribe to our email alerts, and find on-demand versions of some of our previous webcasts. And finally, here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you again for joining us, and we hope you'll join us again next time.